What if there was a roadmap to achieving long-term financial freedom, and you could start following it today? Whether you're just beginning your journey to wealth or looking to optimize your current financial habits, there are proven strategies to help you build a secure and prosperous future. In today's video, we'll explore the top 25 wealth-building principles that will guide you toward financial freedom. These principles are more than just tips. They're essential strategies used by some of the wealthiest people in the world to accumulate and preserve wealth. Stick with us as we dive deep into actionable advice that can change your financial future. Now, let's dive in. 1. Spend less than you earn. Spending less than you earn is the cornerstone of building wealth. It requires living below your means, which ensures that you have money left over to save and invest. It's about making intentional financial choices and avoiding lifestyle inflation, where increased income leads to increased spending. By focusing on saving first and being frugal, you can prevent overspending on non-essentials. Maintaining a simple lifestyle allows you to funnel extra resources into more productive uses, like investments. This discipline also prepares you for times when your income may fluctuate or unexpected expenses arise, giving you financial flexibility. The most successful wealth builders prioritize saving and controlling their spending habits. A simple lifestyle also enables you to be more mindful of what you truly need versus what you think you want. Living below your means isn't just about cutting expenses. It's about developing a mindset that values financial security over short-term pleasure. The temptation to indulge in the latest trends, gadgets, or dining experiences is ever present, especially when you have the means to do so. However, true wealth is created by consistently prioritizing long-term goals over instant gratification. By choosing to save and invest the difference between your income and expenses, you build wealth gradually over time, even without making huge sacrifices in your daily life. Additionally, avoiding debt and not falling into the trap of financing non-appreciating assets like cars or luxury items can go a long way in maintaining this principle. Over time, living below your means not only helps you accumulate wealth, but it also makes you more resilient in the face of financial challenges. 2. Pay yourself first. The principle of paying yourself first emphasizes the importance of saving a portion of your income as soon as you receive it before paying bills or spending on discretionary items. This first payment should go into a savings account or investment plan that aligns with your long-term goals. Automating your savings makes this practice even more effective, ensuring that you consistently contribute to your wealth-building efforts. The key is to prioritize your future over the immediate gratification of spending, setting a foundation for financial security and freedom. Paying yourself first prevents you from spending money on things you don't need and redirects it toward building your wealth, even if it means sacrificing a bit in the present. This principle is rooted in the understanding that paying for expenses, bills, and wants should never come before securing your financial future. When you prioritize your savings or investments first, you make sure that the money is not spent on unnecessary items, leaving less room for impulse purchases. Automating your savings, such as setting up direct deposit or automatic transfers, ensures consistency. Over time, this leads to a growing savings or investment account that will help you achieve your long-term goals, whether that's retirement, a down payment for a house, or funding your child's education. By making savings a non-negotiable part of your routine, you create an environment where wealth building is automatic without needing constant attention. This strategy can also be adjusted based on income levels, allowing you to increase the amount you save when possible, ultimately enhancing your financial security. 3. Set clear financial goals. Setting clear financial goals provides a roadmap for your wealth-building journey. Whether it's saving for retirement, buying a home, or creating a college fund, having specific, measurable goals ensures you stay focused. You should break down these long-term goals into smaller, actionable steps, such as monthly savings targets or investment returns. Revisiting your goals regularly keeps you on track and motivated. Clear goals give you something tangible to work toward, making the financial discipline required to reach them much more manageable and rewarding. When you define what you're working for, your efforts are more focused, and the journey toward your financial future becomes clearer and more achievable. Without clear goals, it's easy to get sidetracked by distractions or the day-to-day struggles that come with managing money. Having a written, specific goal is much more effective than just vaguely saying you want to save more or build wealth. For example, setting a goal of saving $500 each month for the next 2 years for a vacation or a new home is concrete and actionable. Breaking down your larger financial objectives into smaller milestones also allows you to track your progress over time and celebrate small wins, keeping you motivated. Revising your goals as your financial situation changes ensures that they remain realistic and attainable. Additionally, these goals can help guide your spending decisions and avoid unnecessary temptations that may distract you from achieving them. Financial goals create a sense of purpose, making it easier to make tough decisions when you need to. 4. Build an emergency fund. An emergency fund is a financial safety net that covers unexpected expenses such as medical bills, car repairs, or sudden job loss. It's a crucial step in achieving long-term financial freedom because it helps protect you from financial setbacks that could derail your wealth-building efforts. Having an emergency fund prevents you from resorting to high-interest credit cards or loans during emergencies, keeping your finances intact. Aim to save at least 3 to 6 months of living expenses in a highly accessible, low-risk account like a savings account or money market fund. The emergency fund ensures that you're not forced into financial strain when life throws a curveball your way. With this safety net in place, you'll be able to keep your wealth-building plans intact, no matter what unexpected events come your way. The key to building a successful emergency fund is consistency and discipline. Start by setting aside small, regular amounts each month until you've reached your target savings goal. This approach may feel slow at first, but with patience and persistence, your emergency fund will grow steadily over time. Once it's built up, you'll have peace of mind knowing that you can handle unexpected events without sacrificing your financial goals. One of the best things about emergency fund is that it gives you the flexibility to make choices without being held hostage by fear of financial instability. An emergency fund is not just a buffer for emergencies. It's also an important step in creating overall financial confidence and self-reliance. 5. Create a realistic budget. A budget is a crucial tool for tracking income and expenses. By creating a realistic budget, you can allocate your money more effectively towards savings, debt repayment, and investments. Understanding your cash flow, how much money is coming in and how much is going out, allows you to make adjustments if necessary. A solid budget also helps identify areas where you can cut back on non-essential spending and redirect those savings toward wealth-building activities. Consistently following a budget can provide you with a sense of financial control and clarity. Knowing exactly where your money is going empowers you to make smarter, more intentional choices. By maintaining financial discipline through budgeting, you'll stay on track to build long-term wealth. A well-structured budget forces you to take a hard look at your spending habits and helps you become more conscious of where you might be overspending. It's easy to let small, everyday purchases add up, but a budget allows you to pinpoint these areas and take action. Additionally, a good budget takes into account both your fixed and variable expenses, as well as any one-off costs that might pop up unexpectedly. Creating a budget that fits your lifestyle also means ensuring that you have some flexibility for fun and enjoyment without overextending yourself financially. The best part? By sticking to your budget, you'll gain financial confidence and learn to make smarter decisions about how you spend your money, ultimately getting closer to your wealth-building goals. 6. Eliminate bad debt. Bad debt, like high-interest credit cards and payday loans, can stifle wealth-building efforts. It's important to pay off high-interest debt as quickly as possible to reduce the amount of money lost to interest. Once this is done, you can redirect those payments toward more productive areas, such as investments or savings. Avoid accumulating bad debt in the future by living within your means, planning for major expenses, and using credit responsibly. Elimination of bad debt not only frees up money, but also reduces financial stress and improves your credit score. A strong credit score is vital for accessing low interest rates on loans, such as mortgages or business loans, and can lead to better opportunities for financial growth. The process of eliminating bad debt is one of the most important steps you can take in your wealth-building journey. Start by targeting high-interest debts first, such as credit card balances. Pay more than the minimum payment whenever possible to reduce the debt quickly and minimize interest payments. Once you've eliminated bad debt, resist the temptation to take on new, unnecessary debt. Focus on maintaining a good credit score and continue to live within your means. Over time, this strategy will free up more money to invest in your future, whether it's in retirement accounts, real estate, or stocks. By maintaining a debt-free lifestyle, you also set yourself up for financial freedom and flexibility. This approach allows you to save and invest more effectively without the burden of looming payments or interest rates. It also fosters a mindset of financial discipline that will serve you well in the long run. Keep a clear focus on building wealth and avoid falling back into the cycle of bad debt. 7. Understand good versus bad debt. While bad debt should be avoided, good debt can be a powerful tool for building wealth. Good debt includes borrowing to invest in assets that appreciate over time, such as a mortgage to buy a home or taking out a student loan for education that leads to a higher income. The key is to manage debt wisely and use it as a means to enhance your financial future. Leveraging good debt can be beneficial if the return on investment exceeds the cost of the debt. Understanding the difference between good and bad debt is crucial for effective financial planning. Not all debt is created equal. Good debt can actually help you build wealth, especially when it's used to invest in appreciating assets like real estate or education. However, it's important to keep track of your debt-to-income ratio to ensure you're not taking on more debt than you can handle. If you borrow wisely and use debt as a tool for financial growth, you can significantly increase your wealth over time. Remember, the cost of the debt should always be outweighed by the potential returns on your investment. For example, taking out a loan to purchase a property that appreciates in value is good debt, while using a credit card to buy non-essential items is bad debt. The strategy behind good debt is not about using leverage irresponsibly, but rather about taking advantage of opportunities that can create more wealth over time. When used correctly, good debt can accelerate your financial progress, such as buying a home that appreciates in value or borrowing to fund an education that leads to higher earnings. Stay informed about your financial decisions and make sure that any debt you take on contributes to your long-term wealth-building strategy. 8. Start investing early. Starting to invest early is one of the most powerful wealth-building strategies. The earlier you begin, the more you benefit from the magic of compound interest, which is the process of earning interest on your initial investment plus the interest it has already earned. Even small, consistent contributions can grow into substantial amounts over time. Early investing also allows you to ride out market volatility, as you have a long time horizon to recover from market dips. Setting up automated contributions into investment accounts can help you stay disciplined. When you invest early, you give your money more time to grow and benefit from compound interest. For instance, if you invest $100 a month starting at age 25, you could have a significantly larger retirement account by age 65 than if you waited until you were 35 to start. The earlier you begin, the more time your investments have to compound and generate returns. Even small amounts invested consistently over time can result in a substantial nest egg. Don't let procrastination hold you back from securing your financial future. Start investing today, no matter how small the amount may seem at first. The power of starting early is particularly noticeable when compounded over many years, as the impact of your contributions grows significantly over time. Even if you feel like you don't have much to invest initially, starting with small amounts can create momentum that pays off later. You don't need to wait for the perfect moment to begin investing. Every day you delay is one more day your money could have been growing. Establish automatic investments into a retirement account or index funds to make the process easy and consistent. 9. Diversify investments. Diversification is a risk management strategy that involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. By doing so, you reduce the risk that a downturn in one asset class will drastically affect your entire portfolio. Diversification is essential for smoothing out returns over the long term and can help protect your wealth during market volatility. A well-diversified portfolio offers exposure to different sectors and industries, helping you benefit from growth in various areas of the economy. Think of diversification as not putting all your eggs in one basket. While some investments may perform well, others may not, and a downturn in one area may negatively impact your entire portfolio. By spreading your investments across multiple asset classes, you reduce the risk and ensure that a loss in one area won't derail your wealth-building efforts. For example, when the stock market is down, real estate or bonds may perform better, providing a cushion for your portfolio. A diversified portfolio offers a balance between growth potential and risk mitigation, helping you build wealth steadily over time without exposing yourself to significant losses. The goal of diversification is to achieve steady growth while reducing exposure to risk. This strategy is vital during times of market uncertainty or downturns, as it allows you to maintain a more stable portfolio. It's important to include a mix of both high-risk and low-risk investments in your portfolio. For example, while stocks offer higher growth potential, bonds or real estate provide more stability. Regularly review your portfolio to ensure that it remains balanced and aligned with your long-term financial goals. 10. Stay invested long-term. Staying invested long-term means resisting the temptation to make knee-jerk reactions to short-term market fluctuations. The market will have ups and downs, but history shows that long-term investors tend to earn higher returns than those who attempt to time the market. By staying the course and not selling during downturns, you allow your investments to compound and grow. This principle encourages patience, discipline, and consistency, which are all crucial elements in building long-term wealth. It's easy to get caught up in the noise of short-term market movements. When the market is volatile, many investors panic and make decisions based on fear or the desire to avoid losses. However, successful long-term investors understand that the key to wealth building is staying invested and allowing their investments to grow over time. Patience is essential when it comes to investing. Even if the market takes a dip, remember that history has shown time and again that markets recover, and those who stay invested reap the rewards. By adopting a long-term mindset, you avoid costly mistakes like selling at the wrong time and allow your portfolio to recover from downturns. The discipline of staying invested long-term is what separates successful investors from those who try to time the market. It's about being patient, sticking to your strategy, and letting your investments grow over time. Consistency and a long-term perspective are the most important factors in achieving financial success. When you're able to ignore short-term market fluctuations and stay focused on your long-term goals, you'll give your investments the best chance to thrive. 11. Keep costs low. Investment fees and taxes can eat away at your returns over time, so it's important to choose low-cost investment vehicles, such as index funds or exchange-traded funds, ETFs. High fees for actively managed funds or frequent trading can significantly reduce the growth of your portfolio. Additionally, minimizing taxes through tax-efficient accounts or strategies, such as Roth IRAs or 401ks, can increase the amount of wealth you retain. By keeping your costs low, you maximize the amount of your returns that you can reinvest. It's easy to overlook the impact of fees and taxes on your wealth-building efforts, but they can make a huge difference over time. Even small fees can accumulate and eat into your returns, especially when compounded over years. Choosing low-cost index funds, or ETFs, allows you to benefit from market growth while minimizing the drag on your portfolio. Additionally, tax-advantage accounts, such as IRAs and 401ks, can significantly reduce your tax burden, allowing your investments to grow without being penalized by taxes each year. Reducing costs doesn't just apply to your investment strategy. It should be part of your overall financial plan. Review all aspects of your financial life, from insurance premiums to credit card fees, to find ways to cut unnecessary expenses. Streamlining your finances will not only improve your ability to save and invest, but also provide more opportunities to grow your wealth. Keeping costs low is one of the most effective strategies for maximizing the returns on your investments and ensuring a stronger financial future. 12. Rebalance regularly. Rebalancing your portfolio ensures that your asset allocation remains aligned with your financial goals and risk tolerance. Over time, some investments will outperform others, causing your portfolio to become skewed. For example, if stocks perform well, they may make up a larger portion of your portfolio than intended, leading to higher risk. By rebalancing, you sell off high-performing assets and by underperforming ones to restore the desired allocation. Regular rebalancing ensures your portfolio remains diversified and aligned with your long-term goals. Rebalancing your portfolio is an essential practice to maintain a well-structured investment strategy. It involves adjusting your asset mix so that it matches your goals and risk tolerance. Over time, as certain assets outperform, they may cause your portfolio to become riskier than originally planned. Regularly rebalancing your portfolio helps maintain a balanced exposure to various assets, such as stocks, bonds, and real estate. This way, you're not overly exposed to a single asset class, reducing the chances of a significant loss during market downturns. Many investors avoid rebalancing, fearing that they will miss out on further gains if they sell high-performing assets. However, the key to building wealth is not to chase the highest returns, but to follow a disciplined strategy that aligns with your long-term objectives. By rebalancing regularly, you ensure that your portfolio stays in line with your goals and maintains the right balance of risk and reward. Rebalancing can also help reduce volatility by diversifying your holdings across different sectors and asset classes. 13. Wealth is quiet. True wealth isn't about flashy displays of spending or material possessions. It's about quiet, consistent wealth-building strategies that focus on growing assets over time. Wealth is a long-term project built on the steady accumulation of assets rather than short-term gains. When you focus on creating a sustainable financial foundation rather than chasing status, you're more likely to achieve financial freedom. Many of the wealthiest individuals maintain a low profile and avoid conspicuous consumption, preferring to invest their money where it works best. Building wealth the right way doesn't require showing it off. The wealthiest individuals are often the least ostentatious when it comes to spending. Instead, they focus on quietly growing their assets behind the scenes. This approach allows them to build wealth without the pressure of keeping up with trends or trying to impress others. Living below your means, while focusing on investments, saving, and avoiding consumer debt, is the true way to grow your financial foundation. The key is to adopt the mindset of slow and steady progress. Instead of splurging on luxuries or non-essentials, wealthy individuals channel their funds into appreciating assets like stocks, real estate, or retirement accounts. By doing so, they allow their wealth to grow over time, giving them more security and opportunities in the long run. Wealth is not about the amount of money you spend, but the wealth you accumulate through smart decisions and discipline. 14. Don't chase headlines. Chasing the latest investment trends or trying to time the market based on headlines can be a recipe for financial disaster. News outlets and media are often designed to create excitement, frequently focusing on short-term market fluctuations that capture attention but may not have long-term relevance. Research has shown that 60% of investors react to media headlines, with many being swayed by the emotions tied to breaking news. These sensationalized stories, while intriguing, can lead investors to act impulsively, making rash decisions based on incomplete information. It's essential to remember that investing is about the long game, not immediate reactions to market volatility driven by headlines. Successful investors focus on long-term fundamentals and the bigger picture, not the latest news cycle. A study by Morningstar found that long-term investors who stuck to their investment strategy over 10 years consistently outperformed those who try to time the market by reacting to headlines. In fact, between 2002 and 2017, investors who followed the buy and hold strategy saw a return of 7.4% annually, while those who reacted to market swings missed out on this growth due to poor timing decisions. Instead of rushing into investments based on headlines or market hype, these investors stay true to their strategy, grounded in research and long-term goals. By avoiding the temptation to act on every headline or market movement, you can maintain a calm, calculated approach that mitigates the risks associated with emotional investing. Emotional reactions, often driven by fear of missing out, FOMO, lead to poor decision-making. Research by Dalbar, a financial services research firm, shows that investors who reacted emotionally to the market's ups and downs underperformed by nearly 2% annually between 1984 and 2019. Headlines and breaking news may seem urgent, but they often fail to reflect the true value or stability of an asset. In many cases, the market overreacts to short-term events, and chasing these trends can result in buying into an asset at its peak, only to watch its value fall in the coming months. A report by the CFA Institute revealed that over 90% of stock market volatility comes from short-term news and speculative events, not from the underlying fundamentals of companies. Instead, maintaining a disciplined investment approach and focusing on the underlying fundamentals of your portfolio helps you avoid these pitfalls. Investors who stay calm through market volatility, focusing on diversification and long-term growth, consistently outperform those who react to every market swing. Investing based on headlines or emotions may cause unnecessary stress and risk-taking. Staying focused on your financial plan, researching thoroughly, and holding steady through market fluctuations will lead you toward long-term wealth and financial success. The key is consistency, patience, and understanding that true wealth building doesn't happen overnight, but rather through smart, informed, and measured decisions over time. 15. Prioritize financial education. The more you know about money, investing, and wealth-building strategies, the better equipped you'll be to make informed decisions. Financial education isn't something you learn once, it's an ongoing process. Read books, take courses, listen to podcasts, and seek advice from trusted sources to improve your knowledge. Understanding the financial world allows you to avoid costly mistakes and take advantage of opportunities. The more educated you are, the more confident you'll feel in making decisions that benefit your financial future. Financial literacy is one of the most important skills you can develop. With a deeper understanding of finance, you can avoid common pitfalls that trap many people and make decisions that lead to long-term wealth. Many people rely on others for financial advice, but by learning for yourself, you gain a much better understanding of how your money works. You can then apply this knowledge to make better choices regarding saving, investing, and spending. Continuously investing in your financial education is key to growing your wealth. With the wealth of resources available, books, blogs, podcasts, and online courses, learning about personal finance has never been easier. By taking the time to understand how money works, you're setting yourself up for financial independence. The more educated you are, the more opportunities you'll be able to spot, and the less likely you are to make costly mistakes along the way. 16. Increase your income. Increasing your income is one of the most effective ways to accelerate your wealth-building efforts. While cutting expenses is important, boosting your income opens up new possibilities for savings and investment. Look for ways to diversify your income, whether through a side business, freelance work, or additional education that increases your earning potential. Generating more income gives you the ability to save more, pay off debt faster, and invest more aggressively. Many people focus solely on reducing their expenses when it comes to wealth building, but the key to faster growth lies in increasing your income. The more you earn, the more you can put toward your savings and investments, accelerating the growth of your wealth. One of the best ways to increase your income is to acquire new skills or certifications that allow you to qualify for higher-paying jobs or side gigs. Freelancing, consulting, or starting an online business are also great ways to supplement your income while maintaining your day job. In addition to boosting your earning potential, increasing your income allows you to build a larger emergency fund, pay off debt more quickly, and take advantage of more investment opportunities. The key is to look for ways to diversify your income streams so that you aren't dependent on a single source. By expanding your earning capacity, you can create a buffer that provides greater financial security and flexibility, making it easier to weather any unexpected events or market downturns. 17. Avoid lifestyle inflation. Lifestyle inflation occurs when you increase your spending as your income rises, preventing you from building wealth. It's easy to fall into the trap of upgrading your lifestyle every time you get a raise or promotion. However, the key to building wealth is to keep your expenses relatively stable, even as your income grows. By continuing to live below your means and redirecting any additional income towards savings and investments, you can make faster progress toward financial freedom. The temptation to indulge in lifestyle inflation can be strong, especially as you start to earn more money. It's easy to think that because you have more income, you deserve to spend more on luxury items or experiences. However, the truth is that building wealth requires restraint and discipline. Instead of upgrading your lifestyle as your income grows, focus on saving and investing the extra money. The more you can keep your expenses stable, the more you can invest, which will pay off in the long run as your wealth grows. Living below your means doesn't mean you have to deprive yourself of enjoying life. It simply means that you are prioritizing your financial future over short-term pleasures. By being mindful of your spending habits and making intentional choices about how to allocate your income, you can avoid the trap of lifestyle inflation and accelerate your path to financial freedom. The more you can save and invest, the sooner you'll be able to enjoy the benefits of your wealth-building efforts. 18. Protect your assets. Insurance is an essential tool for protecting your wealth. Whether it's life insurance, health insurance, property insurance, or disability insurance, it's important to have a safety net in place. These types of insurance help ensure that an unexpected event, such as a health issue or property damage, doesn't derail your financial plans. Protecting your assets is a proactive way to safeguard your wealth against risks that could otherwise create massive setbacks. Insurance might not seem like a fun or exciting part of wealth building, but it's an essential element of any strong financial plan. Without adequate insurance coverage, a single accident, illness, or unexpected event could wipe out your hard-earned savings. That's why it's important to carefully assess your risks and choose the right insurance policies to protect your most valuable assets. Health insurance can help cover medical bills. Life insurance can protect your family, and property insurance can safeguard your home and belongings. Beyond basic insurance, consider additional coverage options that can protect you from other potential financial risks. For example, disability insurance can provide an income replacement if you're unable to work due to illness or injury, while umbrella insurance can provide extra liability protection beyond your standard home or auto policies. By ensuring that your assets are properly protected, you can continue building wealth without the constant fear of unexpected setbacks. 19. Know your net worth. Your net worth is a key metric that helps you track your financial progress. It's the difference between what you own, assets, and what you owe, liabilities. Regularly calculating your net worth gives you a clear picture of where you stand financially and helps you identify areas that need improvement. If you find that your liabilities exceed your assets, you can take steps to reduce debt and increase savings. Tracking your net worth regularly allows you to see the big picture and stay focused on your long-term goals. Many people go through life without ever calculating their net worth, but it's one of the most powerful ways to measure your financial health. By listing all your assets, like savings, investments, property, and any other valuable items, and subtract your liabilities, such as credit card debt, loans, and mortgages, you can determine where you stand financially. Knowing your net worth provides insight into your progress and helps you set realistic financial goals. It allows you to see if you are on track to meet your wealth-building objectives or if you need to make adjustments. Tracking your net worth regularly also helps you stay focused on reducing debt and increasing your assets. As you pay off loans and accumulate more savings or investments, you'll see your net worth grow. This will motivate you to continue making wise financial decisions that will help you achieve financial independence. It's a simple yet powerful tool for keeping track of your progress and ensuring that you're making strides toward your long-term financial goals. 20. Have a financial plan. A comprehensive financial plan outlines your short dash, medium dash, and long-term financial goals. It acts as a blueprint for managing income, expenses, savings, investments, and insurance. A well-thought-out plan also helps you track progress and adjust strategies as your circumstances change. A financial plan isn't a one-time exercise but should be revisited regularly to make sure you're staying on track toward your ultimate goals. Having a financial plan in place reduces uncertainty and provides clarity in decision-making. Without a financial plan, it's easy to make impulsive decisions that aren't in line with your long-term goals. A solid financial plan takes into account your current financial situation, your future aspirations, and the steps you need to take to achieve them. It provides a roadmap for everything from how much you should save each month to how much you should allocate to investments. The key is to ensure that your plan is realistic, flexible, and aligned with your values and long-term objectives. Creating a financial plan also helps you make better financial decisions. It gives you a clear picture of where you are, where you want to go, and what you need to do to get there. Revisit and update your plan regularly to reflect any changes in your life, such as a salary increase, a new family member, or a change in your financial goals. A financial plan gives you control over your financial future and ensures that you're always moving in the right direction. 21. Plan for taxes. Taxes can significantly impact the amount of wealth you accumulate over your lifetime, so it's crucial to have a strategy in place for managing your tax burden. The key to minimizing taxes is not to evade them, but to take advantage of tax-saving strategies that legally reduce your liability. This includes using tax-advantaged accounts like Roth IRAs, 401(k)s, and HSAs, which allow your investments to grow without being taxed until you withdraw the funds in retirement, or even tax-free in the case of Roth IRAs. Tax planning also involves understanding tax brackets, deductions, credits, and ways to lower taxable income, such as through charitable donations or capital gains. By working with a tax advisor, you can create a tax-efficient strategy that maximizes your wealth potential while minimizing the amount you pay in taxes. Furthermore, managing your investments to minimize taxes, such as through tax loss harvesting or investing in tax-deferred accounts, can keep your wealth intact and growing. Proactive tax planning can make a huge difference in the wealth you accumulate over time. When done properly, you can save thousands of dollars in taxes, allowing you to reinvest that money into wealth-building activities. Staying informed about new tax laws, changes in tax rates, and how to take advantage of them will ensure that you're always using the best strategies to protect and grow your wealth. When you know how to leverage tax-saving opportunities, your wealth-building efforts become significantly more efficient. Finally, regularly reviewing your tax situation will help you stay ahead of any changes, allowing you to adjust your financial strategy accordingly. This is especially important as your income grows or your financial situation evolves over time. Efficient tax planning not only ensures more money in your pocket, but also helps you stay on track to achieve your long-term wealth goals. 22. Focus on behavior over timing. When it comes to investing, focusing on behavior and consistency is more important than trying to time a market. Market timing, which is the act of buying and selling investments based on short-term predictions of price movements, is extremely difficult to do successfully and consistently. Instead, successful wealth builders focus on disciplined and steady behaviors like consistently investing a fixed amount, no matter the market's current state. This strategy is called dollar-cost averaging. By contributing a set amount to your investments on a regular basis, regardless of market fluctuations, you ensure that you buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy reduces the impact of market volatility and lowers the average cost of your investments. Consistency in investing means you're not waiting for the perfect time, but rather focusing on the long term, which ultimately pays off. Staying invested through market ups and downs and focusing on long-term goals is one of the best ways to build wealth. Emotional decision-making, such as panic selling during market downturns or chasing hot stocks during booms, can lead to poor financial outcomes. A consistent and disciplined approach to investing will allow you to take advantage of the power of compounding, making your wealth grow over time. Behavior over timing ensures that you don't get caught up in market noise. If you focus on your strategy and adjust it only when necessary, based on long-term performance and not short-term shifts, you'll avoid making costly mistakes. It's about having the patience to stay invested, knowing that over time, the market tends to grow, and so will your wealth. 23. Be disciplined, not emotional. Emotional decision-making can be a significant barrier to building wealth. Financial decisions driven by emotions, such as panic selling during a market downturn or chasing high-risk investments during a bull market, often lead to poor outcomes. Disciplined investors follow a plan based on logic and long-term objectives, rather than reacting to short-term events or market noise. The financial markets are emotional by nature. There are ups and downs that can trigger fear, greed, and anxiety, leading to impulsive decisions that derail your financial progress. The key to long-term wealth building is to develop a plan, stick to it, and not let emotions cloud your judgment. This means resisting the urge to make quick decisions based on temporary market events or headlines. One way to stay disciplined is to set long-term goals and create a clear investment strategy. This includes having an asset allocation plan that reflects your risk tolerance and time horizon, as well as choosing investments that align with your goals. By staying calm during market downturns and ignoring short-term volatility, you'll be in a much better position to achieve financial freedom. It's also helpful to surround yourself with trusted advisors and mentors who can keep you grounded during market fluctuations. They can offer valuable perspectives and remind you of your long-term objectives. Keeping emotions in check isn't just about resisting fear. It's about not letting the excitement of a market surge drive you to take unnecessary risks. Sticking to your strategy and remaining patient will guide you towards lasting financial security. 24. Use compound interest. Compound interest is one of the most powerful forces in wealth building. It allows your money to grow exponentially by earning interest on both your initial investment and the interest it has already accumulated. The earlier you start investing, the more you benefit from this growth effect, which accelerates as time goes on. Starting early is key when it comes to compound interest. Even small, regular contributions to an investment account can grow significantly over time as the interest compounds and builds on itself. For example, investing in low-cost index funds or a retirement account early in life can yield substantial returns by the time you retire, thanks to compound interest. The longer your money is invested, the more time it has to grow, which is why starting as early as possible is so important. To make the most of compound interest, it's also important to reinvest dividends and interest. Many investment accounts allow you to automatically reinvest dividends or capital gains, meaning your returns continue to compound even faster. The more you can invest, the more compound interest works in your favor. So always aim to maximize your contributions to your investment accounts. While compound interest is incredibly powerful, it requires patience. It may not seem like much at first, but over time, you'll see your wealth grow exponentially. The sooner you start, the more time your money has to compound and grow. This principle is essential to financial success because it turns even small, consistent investments into substantial wealth over time. 25. Track and adjust. Regularly tracking and adjusting your financial plan is essential for staying on track to reach your wealth-building goals. Life circumstances, income, and financial priorities can change, so it's crucial to periodically review and make adjustments to your budget, savings targets, investment strategy, and insurance coverage. By reviewing your financial plan regularly, you ensure that it remains aligned with your goals and that you can make necessary changes in response to market shifts or changes in your personal situation. Tracking your financial progress is vital because it helps you see where you stand in terms of your wealth-building journey. If you're not reaching your targets, you can make adjustments to your approach, whether it's saving more, cutting back on unnecessary expenses, or increasing your income. Additionally, tracking your progress helps you stay motivated and focused on your long-term goals. The more regularly you track your wealth-building efforts, the easier it will be to spot areas for improvement. It's also important to be flexible with your plan. Life is unpredictable, and unexpected events can sometimes disrupt your financial plan. Being able to adjust your plan and make changes as needed will help you stay on course and avoid setbacks. By regularly reviewing your financial strategy, you ensure that you're always making decisions that bring you closer to your financial freedom. Tracking and adjusting your wealth-building efforts helps you stay proactive in reaching your goals. It's not enough to set a plan and forget about it. Regular adjustments will allow you to optimize your strategy and ensure that you're moving towards the wealth you've envisioned. And there you have it, 25 wealth-building principles that, when followed consistently, will help you achieve long-term financial freedom. These principles aren't just tips. They are actionable steps that, if applied properly, can set you on the path to financial security and independence. Whether you're starting from scratch or looking to optimize your financial situation, these strategies will help you build a solid foundation for the future. If you found this video helpful and want to learn more about wealth building, don't forget to like, share, and subscribe. Let us know in the comments below which principle you're most excited to start using. And if you want more tips, keep an eye on our channel for upcoming videos. Thanks for watching, and we'll see you in the next one.